On today's show, 3 questions. Number 1, does your mood affect returns? Number 2, where is housing most expensive? And number 3, has the ownership window closed?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Lauren.
And I'm Rabih.
Yeah, you are, Rabih. The most important thing here today is we're on baby watch, Lauren. We are on baby watch. Where are we at?
Oh, gosh. I have 7 weeks, 6 weeks. I think it's 6 now.
6 weeks of just growing a human, doing more work than any of us combined.
Yeah.
It's amazing.
I definitely have that pregnancy brain thing going on. So we'll see how well I can get through conversations.
Well, guess what? I don't have an excuse. I've got pregnancy brain without the baby. So it's all good. Wait, isn't your due date near my birthday? I can't remember. What's your due date?
It's October 2nd.
Okay. Well, if you go 20 days late, then it'll be it'll be right there.
Yeah,
So,
I'll hold out for that. I'll make sure that.
Let's hold out. I was really hoping that Megan's baby was going to be her due date was my birthday. And
was it?
Little Walter came, I think, before. So we didn't share a birthday. I was trying to get her to name him Matthew, but she wouldn't. It's okay.
I feel like that fits out for me a little bit better. I'll name it after my husband. I'll do it.
Oh, there you go. Yeah, he's got a good, solid name. Perfect.
Yeah.
Okay, guys. Well, excited to be here. We got a lot of great topics. And then after this, I guess I'm flying the worst possible time of year, probably. I'm going to Vegas this weekend.
Oh,
so,
what for?
Just to go visit some friends and hang out. I'm going to Michael, the play, like the show, like this.
Fun!
The whole like Circus Olay show. Super excited, but probably couldn't have picked a worse time to go to Vegas. I think it's like 110 degrees either way.
I used to have to walk home in that every single day. So just
you're like,
keep
I
that
don't feel
in
bad.
mind.
I don't feel bad for you. Yeah.
Every single day I'd call my dad crying, being like, please come pick me up. And my dad was like, Lauren, it's 2 blocks. Like,
you're like, it's also 170,000 degrees right now. Okay, we digress. Let's jump in. Rabih, we teased this last week. We were kind of going over what, as far as moods and how that impacts returns. So consumer confidence and the relationship there. So let's spend more time on that. Rabih, tell us how do moods affect returns?
Yes. So last week, while we were discussing the Michigan Consumer Sentiment Index, right? We were interested, like, is there really a relationship or a strong correlation between consumer sentiment and how confident they are about the economy and the actual return in the stock market? And what we ended up on last week said that, hey, this is not causation. This is definitely correlation. It's not causation. But the data is strong and it's worth looking at. So what I did is that I prepared that data for you guys. And I'm going to share my screen for everyone to see. And let me know if you see
YouTube, like and subscribe.
And let me know if you guys can see this graph. You guys can see it?
Yeah.
Okay. So what we have here is in black, the result of the consumer sentiment or consumer expectation survey. And then the blue dots are what the return of the S&P 500 was 12 months after that. So if we look over here on August 1972, the consumer confidence was up in the like 88, 89 level. And 12 months later, if you look at the S&P return, it would have been negative 6.9. Versus if you go down to, for example, August 2011, the consumer confidence was all the way down at like 49, 48. And 12 months later, the S&P return was
skyrocketed.
Up 15.4. And if you look at the top left box within the chart, it tells you that when there were peaks, and there were 10 measured in this article, the average return was 4.8% on the S&P 500. But when you were in troughs, the average return was 24.1. Right? So this is definitely a difference in return. It's not like, it's 50-50. It's not like we saw returns of 7% versus 6.5. We're seeing a difference between 4.8 and 24.1. So that is big enough of a gap for you to say, okay, there is something happening there. It might not be that one is causing the other. It could be just that there's a correlation. And what builds that correlation and what brings it to fruition? What do you guys think of that chart so far?
I'm still like trying to wrap my mind around it, mainly in mainly in today's context. Because if I'm reading this right, Rabih, tell me if I'm wrong here. But we're at a pretty low point right now. We're near a trough of like consumer confidence, correct? We're also at all-time highs in the market.
Yes.
So I'm like trying to wrap my mind around like how this connects to, and again, we're not saying this is pure causation. So it's kind of the same thing we talk about with like, we saw a yield curve inversion for 2 years, just a few years ago, and we saw no recession. So it's not like one leads to the other all the time, but I'm just still trying to wrap my mind around this idea that we're so low in the confidence of the economy, according to the metrics, but the market is just continuing to crush. And I guess I'm just still left a little bit like, what does this all mean right now?
Yes, which is a very good observation, because sometimes, like here in 1975, 1980, 1920, and then 2008, that drop in consumer sentiment has coincided with recessions, right? And it makes sense on these shaded bars that the return for the S&P after 12 months is much higher, because you're coming from a low in the S&P 500 itself, correct? But then you've got stuff like March 2003, October 2005, April 2020, which was like not really a recession, but the COVID thing was happening. And now June. What this tells you is that the stock market, if this follows through, is just going to be making more and more all-time highs. And we know that once a market makes an all-time high, the probability of it making another all-time high increases dramatically, because all it takes is just a small bump up. So I don't think it coincides more with recessions because the stock market will be down that way. But when it's at an all-time high, if this tells you anything, it's like we're going to be stretching the envelope even further, making bigger all-time highs. And we're seeing it in, the stock market over the last 3 weeks. We've been having a great rally across the board that's making all-time highs.
Yeah. So to that point, I think that's where I'm the most confused as to right now, because what you just said is exactly how it connects in my brain, which is, yes, it totally makes sense that at these recession points, these downward points where everyone's coalesced around this idea of like, this just kind of sucks right now, is, market's down, economy struggling. Yes, it's a perfect point for a rally. So that totally makes sense. Again, right now, I think I'm quite confused and have been for a bit around the market, the economy. Everything's doing really well, but everyone just feels like it sucks. And part of it might be political, maybe. I think we're in a year of midterm elections. I think there's a lot of political pressure right now, or political kind of impact there, but it still is it feels different right now than anything else on this chart. But maybe I'm wrong on that.
You are completely correct, because if let's zoom in at like how this data comes up, this consumer sentiment data, how it shows up, and let's zoom in at like what drives the return of the stock market and see if there are any factors of commonality between them. Because if there is, then this is what would be creating this inverse relationship, where when sentiment is really down, the 12-month subsequent returns on the S&P are high. So for the consumer index, it's just a survey, and it asks these 3 questions. How do you view your own financial situation? How do you view the general economy over the near term? And how do you view the economy over the long term? Remember, this is just, you're asking consumers what they view, and they're asking that every month, 50 questions for a minimum of 500 people. The samples, they are statistically designed to represent all American households, excluding Alaska and Hawaii. So this is,
why excluding them? Hawaii is like, everything's great.
Anyone in Hawaii is like,
and Alaska is like, everything sucks.
Hawaii's like, well, my life is awesome. I don't even care.
So, same with Alaska, right? Alaska would be awesome too. Sign me up.
Yeah, exactly.
So this is how the survey is coming up, and it's given that it's only asking you how do you feel and how do you view the economy, and the fact that this is sent to American households who, we know financial literacy in this country is low, let alone economic, depth and knowledge about the economy, you would see that these collected data points are influenced by a lot of stuff. And what you mentioned, Matt, was so interesting because this data, the 500 household, it's split by age demographic, by education level, by political party, etc. And post 2016, the data that comes from the Michigan Consumer Sentiment Survey has been very, very polarized. So instead of everyone aggregating towards the middle and everyone going up at the same time and everyone going down at the same time, in terms of their sentiment, there's a big divergence. Where depending on the party where the president comes from, the people who share the same political party have a very high consumer confidence and a very stubborn consumer confidence, whereas those who are on the opposing end, they are much more pessimistic. So now that data is very scattered and we're still looking at the average, where in reality is much more scattered and people know less really and their opinions are less. So there is the sentiment is polarized. It is, probably aspects that happen in the background that we're not aware of. And it's very important. The stock market is growing as a function of companies producing new services and products and selling them because people see value on them, and the quality of life of everyone is increasing. So on the broader term, we see that the stock market during when consumer confidence is low is going up. But is that increase, like the 24.1 increase, solely coming from the fact that confidence is low? Well, not really. The stock market more often than not is going up, right?
Yeah.
It's more often than not going up. When it's in a recession, it's going to go up afterwards. When it hits an all-time high, it's going to go up afterwards, especially that we're measuring an index like an S&P 500. So the fact that on up years it's going up 24%, this does not mean that all of that just coming from from the fact that we're starting from low expectations. It's just probably expectation contributes 3 or 4% to those 20. It's just the market is going up during these times.
Yeah.
And to be honest, 50 questions for over 500 people asking them about the whole US economy. This is also a tiny sample in this 21st century word and age of AI. And so, yes, kind of what Wall Street thinks of this survey is that this is a coinciding indicator. Like, it happens that when you are feeling bad about the economy, your 401k is down as well. This is contributing, and the stock market controls your 401k balance. So they happen in between. But the consumer confidence survey is backwards looking because of our biases about recency as humans. It's a survey. So if you've had a couple of 3-4 months where, my 401k is bad, inflation is high, I'm not feeling great about the economy, my job isn't growing, etc. What would happen is that you would still feel bad for a while, but the stock market is forward looking up to like 6 months ahead, and the stock market might start recovering way when consumer confidence is still low, which is what we're seeing right now.
Yeah. All I hear there, Rabih, is this is, especially nowadays, probably really hard to get accurate readings on this stuff, more so than in the past. Lauren, I want to bring you in on this because a lot of this is just kind of like vibe checks. It sounds like kind of like, how are you feeling? And Rabih, it's a good point around like the limitations of like financial and economic literacy when you ask these questions. A lot of it is just like literally vibes. Lauren, I'm curious from your perspective. You're in the trenches every day, talking to dentists, on consultations, on client calls. Where do you feel like where are you sensing the vibes on the dental front? It's not data dependent, but just kind of like what you're hearing in regards to like the economy and the markets. Any themes that have come up on your end?
Yeah, I feel like with my own clients, like I feel like we talk about it a lot. So I feel like my clients aren't the ones necessarily that are bringing up like, oh, everything is doing so bad, because I'm showing them how things are doing well.
Yeah.
But I do feel like it's actually my friends that will come to me. So it's like the community that I'm surrounded by. I hear it so often. Like I have, a friend that's in housing actually, which we'll like talk about later, but people are complaining that housing is so expensive, and people are complaining about how rates are so high. And she just messaged me today to say, I am busier than I've ever been in my life. But she also, like the other day, was like, oh, the economy is so bad at the same time. And I'm like, you're busier than you've ever been, though.
Yeah.
So,
wait, is she a mortgage broker or
she's a
real estate agent?
A lender.
Oh, mortgage.
So she's doing lending.
Yeah.
But I just thought it was so interesting that she had said that as well. Like she said kind of two things. Like the other day we were just driving and she brought it up. But I also saw an article the other day saying that like consumer debt was at an all-time high too. So I'm almost like, we keep saying that all of those, companies are doing so well. But I'm like, is it almost like secretly kind of like the housing crisis where people are getting more consumer debt and more credit card debt and somehow the bubble is going to pop? I don't know.
Yeah, it's a good point, Lauren. It's super interesting to hear like your community people as a younger person, both of you younger than me, you know the vibes of the younger people better than
the younger people are concerned.
You're concerned. But yeah, Rabih and I talked about this on a show. Was that last week, Rabih, or the week before? We talked about the consumer debt as a whole. Something like 13.5 of the 18 billion is housing, and then the rest of the 5 and change was spread across things like credit cards, auto loans, and all that. You're totally right. If you look at the data, the delinquencies in that smaller portion of the 5 billion are up for sure. The interesting part, though, is you reference the housing is this a housing crisis? Because I think there is kind of an undertone of like, are there issues in the housing market? But if you look at delinquencies in the housing market, as Rabih and I hit, it's under 1%. It's like 0.5%. Like I just went through the loan process. And there's no, it is so.
They turn over every stone.
Every single stone, I feel like I was I was running for office. I'm like, wait,
they're like, what's your blood type?
Yeah, exactly. Let me talk to your children and see if you're a good father or not.
Yeah.
Please. So with that said, Rabih's mentioned this before. The bubble is not, we don't necessarily know where it is, cough, AI, but it's certainly not housing. Like no data points to it being housing.
No.
That is interesting though, Lauren, that your friend is as busy as she's ever been on the lending side. That's crazy. So
she's like, I'm so busy. I've got so much work going on. She went on a trip to Europe and had to work while she was there. Couldn't even take a 2-week break. And had to like work and keep doing business. And I'm like, that is so crazy.
Let's just throw this out really quick. Is this something, I don't want to be too flippant about this. But I wonder if this truly is just like this. So, when you talk to people and you say like, how are things? And the default answer is just like, oh, I'm so busy. They like may or may not be busy.
True.
But that's just kind of the default answer. I feel like that we're kind of in a day and age right now where it's like, you almost just have to complain about the economy. Like, oh, in this economy, like, are you kidding me? Like, it almost feels like this like mimetic wave has grown where we just all copy each other. And it's like a default answer. Like, oh my gosh, things just suck right now. But like,
think secretly.
But do they actually suck right now for for people? I mean, again, I don't want to be flippant. I know it hurts for some people. First-time home buyers, I know it's brutal. But I also just think it's one of those things people just say now. Like, yeah, I'm so busy. The economy just sucks. Because the data doesn't support it.
For sure. I feel that way for sure. Like emotionally, this is going to sound silly and like get into psychology of my own brain. But if someone asks me how I'm doing, I feel like I have to say something good and something bad at the same time. So I don't look
interesting.
Like I tell myself that I'm like nervous, that I look rude, where I'm like, I'm doing great. I'm doing so good, which I am. And then I'm like, but I don't sleep.
But also this economy.
just in case you think I'm like trying to like one up you in your life or something, I feel like I have to see it like just in case.
Yeah.
Sometimes it sucks still too. Like it's good and bad, peaches and pits every single time.
Yeah. Rabih, I want to get you in on this. What are your thoughts?
No, I completely agree. It's no coincidence that in this economy has become a trending meme, right?
Yeah.
Everything you say, people say, oh, in this economy. So
yeah, I think that's interesting. Well, this leads into the next topic, I think, perfectly, because we've got more data to support that it actually isn't as bad as what people claim, specifically in the housing space. So let's jump into this. This question here is, where is housing most expensive? Lauren, I'm going to throw this to you just to kind of set this up around this article and this topic.
Yeah. So we hear again all the time that housing is super unaffordable, even though my friend is super busy. I don't get it. But I think there's truth to it. But I came across a chart that made me rethink the conversation a little bit. And the US actually isn't the most expensive place to buy a home, which
not even close.
I think is interesting and surprising. So in the US, I feel like it's such a trendy topic to just be like, I can't afford a house. And honestly, I feel like I'm one of them. I feel like I bought a house right at like the perfect time where like, now I feel like I'm stuck in this house that that I'm in forever. So I feel like I'm one of them too. But relative to income, the US actually isn't the worst offender of trying to get a home for the price. So yeah, I just thought that was super interesting. Yeah.
So the visual, there's a article we mentioned him before, Ben Carlson, but there's a specific, somebody posted to him from the Visual Capitalist that they posted, I don't know, probably in the last week or so, specifically a home price to income ratio chart across the world. So let's get this out of the way first, I think, is that it's really important to understand like reference groups. And just because someone else in another country is doing worse than you doesn't mean like your situation still can't feel hard, right? So like, let's get that out of the way. We're not saying you shouldn't be worried about home prices in America being so expensive relative to what they used to be just because someone in another country is doing worse. Like we're acknowledging that. But I do think this is important. I'm glad you brought this up, Lauren, because I think it's just kind of, I like kind of taking a step back, looking at the 30,000 foot view and understanding, just kind of getting some context, right? So to your point, so again, this is home prices to income ratio. So it doesn't mean that home prices have not gone up in America. They absolutely have. We all know that. It's just saying that price to incomes have also gone up. As you've pointed out here, Laura, the US is the seventh lowest in the world of price to income ratio. Rabih, did that shock you when you saw that?
No, not really, to be honest.
You're like, I got really. The data always locked in.
Not really. It makes sense. Let me give you guys some of the numbers on the chart, so it's easier to compare for our listeners. So in the US, the home price to income ratio is 4.5. So usually, this means like a house is $450K on average, and average income for the household is $100K. That is how they got to that number.
It's about where, that's about where we're at, exactly.
Yep. Canada is around 9.4. France is 11.8, Germany 10.7, Italy 9.7, Great Britain 8.3, and then you'd go, I don't know, for Middle East, like for example, Saudi Arabia, it's 3. It's much lower. If you go to India, it's 9.2. If you go to China, it's the highest or second largest. It's 34.6. Australia is 7.5. So it just tells you that there is a really big gap between the income and the housing, and the US is on the lower end. I would say it's not because houses in the US are cheap compared to the rest of the world. It's because incomes in the US are much higher compared to the rest of the world.
So why do you think we complain about it so much? Like, do you think it's like our lifestyles? Like, it's not about the housing prices anymore. It's about the lifestyle that we like have to change to be able to get into a certain type of house, right? Like the same people can get into a $700,000 house and two different experiences will happen where it's like if one's income is lower and one's income is higher, one person will be like, I'm stuck here forever, or something like that. Or I just think that's interesting that it's the question about what changes there.
I think it's all relative. So again, I do truly acknowledge that things changed so quickly. I think that's part of it. Is it changed so fast. Mm-hmm. Rates went up so fast. Prices skyrocketed in the US pretty much across the board very quickly. And depending on the city, that's the other part of this is very regional. So like in Salt Lake City right now, like we are one of the fastest increases of anyone in the entire country. So people in Salt Lake City, it truly was an impact and a shock. And if you happen to be coming out of or you're in a certain age, over like if you're like that first time home buyer age, which was typically, let's say in the mid 20s, late 20s, whatever, early 30s, like for people in that age group, Rabih, I'm sorry, Lauren, I'm sorry, like someone in that age group, that it really is painful. Like I absolutely feel for those people, but it's also again, relative, if you look at country, like more developed countries, even Australia or Canada, I guess the point here is just like, it could be far worse. It's not as bad as the complaints, Lauren, to your point. But I'd love to get Rabih's thoughts on that too.
I think we're in a very advantageous position in the US. If we go back to first principles, right? The price of timber and steel and iron and energy is the same all across the world. Like if you want to buy a ton of timber or wood to make a house, it's going to cost you the same whether you're buying it in Australia or whether you're buying it in the US. Raw material is raw material, right? And that's why there are future markets for all these raw materials out there. It's the same. Those have been going up, whether it was because of supply chain bottlenecks and wars since the end of COVID, or because of now that there is demand for everything just because there's, I don't know if you've heard of this, but like data centers are sucking up all the raw materials to be built, right? So those have been going up. That is on the housing end front. But when it comes to the income end, what determines how much people make is the supply and demand of labor within that country. So they are completely two different things. One affects the whole world combined. That is the price of raw material. The other one is very domestic. Your salary is really dependent on the supply and demand in your industry that you are working in. And other places around the world, for example, China, right, where the housing prices are as high, and they have surplus of housing, by the way. It's not like they don't have housing. They've got ghost villages of so many empty houses. But their population is so high and their unemployment rate is so high because there isn't really demand for labor. They've got plenty of that labor. People do not make as much money. And that is why the ratio of the house price compared to their income is so wide. So it's really because we're trying to compare two systems that are completely independent of each other. One is the demand and supply of labor that determines income. And the other is just raw materials and the price to extract them in a globalized economy.
Yeah, it's a great point, Rabih. I was also just looking up, just for context, I think it's kind of interesting to see, and I literally just on the spot did this. So Rabih, I'll have you verify my numbers. But I wanted to look at historical figures so for example, we look at rates right now, mortgage rates, and it's really easy to complain about how high rates are, right? But if you look at historical mortgage rates, we're like pretty close to the average over the last like 50, 60, 100 years in America. We're not that crazy. It's not that crazy to be in the sixes. I've said this before on the show, but my dad was an appraiser for 40 years and a real estate investor. And he remembers back in the 80s, 70s and 80s, mortgage rates in like the 16, 17, 18% rate. So again, it's all relative, but I wanted to look here. The national U.S. home price to income ratio is roughly 5 to 5.1. This is most recent. That is nearly double the historical recommended maximum ratio of 2.6. So again, we are higher by double than what our national or what our average is. During the 80s, we were like 3.4 to 3.5. During the 90s, it was 3.2. In the mid 2000s housing bubble, it spiked as high as 7. And in the post-pandemic 2022, we hit as high as 5.8. So it's saying right now we're around 5. This chart might be a little bit out of date. This chart says it's 4.5. Maybe there's a little bit of, depending on where they're pulling the data. So again, we are higher than normal for sure. Than what our historical average has been, but I guess it's just all relative. Any other thoughts, Rabih or Lauren, on this? Go ahead, Rabih.
So we had mortgage rates go up compared to the last 20 years, but we also had bigger house sizes, right?
Yep.
And we also have this U.S. culture that is more home dependent compared to the rest of the world, where the rest of the world, a lot of times, the amount of people living in the same house is much larger. It's usually the kids and the siblings and sometimes cousins, etc. And in other places around the world, usually people inherit the house and just live in the house whereas in the U.S., every single new couple wants a house, right?
Yep.
Those are factors that makes the U.S. housing market kind of unique compared to the rest of the world, but they are all contributing to making it harder to be able to find a house compared to the rest of the world.
Yeah. And Lauren, I think you made a good point earlier too about just the consumerism of America as a whole. We've talked about this a lot, and where expectations adapt and adjust. Like, for example, we spend over 8 times, inflation adjusted, over 8 times per year on vacations than we did in 1950. So
we're not going camping anymore, right?
Yeah, our definitions
camping
of what
is expensive too.
Yeah, it is. I've done it recently, and it is not cheap. Nothing seems cheap anymore.
Yeah,
but I do think that is important too. Is we get used to and adjusted to being able to kind of have it all in America, and being able to still travel. International trips back in the day used to be like once in a 10-year period. Now it's like, if I'm not traveling twice a year internationally,
if I'm not going to Europe every year, I'm upset.
Yeah, I'm like a peasant. Like, what's wrong with me?
Yeah, I'm such a nerd.
Exactly. So I do think that's important to also understand here, or to call out, is what used to be luxuries now feel like necessities. That's like the luxury trap we fall into consumerism. And I think that has an impact here when we do see a legitimate increase, a legitimate change to housing. That's real. But also, I think it feels like more of a crisis than it actually maybe is. Both because political pressures and all that, you kind of like infighting there, but B, because of what our expectations of what a good life is. Like, I think that has
what is the American dream? Is it a house anymore? It's like, it's Europe once a year.
It's a valid question. I think people want both. I really do. Rabih's smiling. Rabih.
I do.
No, I thought what Lauren said very funny. Like, the American dream is to go to Europe once a year. It's leaving.
That is
funny.
Dream.
I didn't think about that. The American dream is to leave.
Is to leave America. Some people
at least once a year.
Some people do think that. Okay. Anything else on this? I think it's interesting. One other thing I wanted to add: there have only been a few instances in which growth in real housing prices has eclipsed growth in real disposable income. And right now we are in one of those times, but it is like a tight gap. If you look at, again, comparison globally to Canada, Australia, the UK, it is like night and day. The gap right now in Australia between real housing prices and where disposable income is, it is all-time high, I believe, or close to their all-time high. I think buying a home in Australia right now would be so brutal. So same thing with Canada, though, and the UK. Like, the incomes are just not growing. So again, it's real. I don't know if I would categorize right now as a crisis, as what a lot of people have highlighted and called it a crisis. I think that's probably a bit of a mischaracterization of that. The other thing, really quick on this, notice that chart there, guys, how tight that is between housing and real disposable income in the US. It's almost lockstep since 1975, with like a couple of like blips here or there, but they basically just are almost right in line. It's kind of surprising, or kind of interesting to look at there. Any other thoughts, guys, on this? Any of the comments on the housing? Are we in a crisis or not? I'd say nay. Rabih?
Nay.
Nay.
It's not right. If the only issue that's making housing painful in this day and age of the U.S. is the lack of supply of houses because we have a low inventory prices, this is not really a crisis. A crisis is when the whole country, the average citizen, can't ever get a house ever for the generations to come.
Yeah.
Which what happens in other parts of the world.
Exactly. It's a good point. Yeah, it's like, if I can't go on my European trip and buy a house this year at the same time, like, that's not a crisis. I'm sorry.
It is for me.
It is for Lauren. Her American dream is to get to Europe.
Is to go to Europe.
That is her American dream. So, okay, we'll move on. Last question here, a more dental specific, is, has the ownership window closed? So to set this up briefly, there was a publication that came out, I believe it was Tusk, who posted and shared some data from the American Dental Association talking about the consolidation of dentistry. And it kind of made the rounds a little bit in the dental space. Went viral, if you will, in the dental space. Not really. But the headline kind of topic was, dentistry is 35% consolidated. And that kind of caught me off guard. I was like, that does not, vibe check does not feel right. So shout out to Brian Hanks, friend of the show, friend of Dentist Advisors. He's awesome. He wrote an article in Dentistry IQ, so you can check it out. So he says the title of the topic, or of the article he wrote, is Dentistry Really 35% Consolidated? Let's check the math. And Brian does a fantastic job of breaking down this data in more of a nuanced approach. So I'll just kind of cover this really quick and then get your guys' thoughts. But there's really kind of 3 different numbers that they just kind of took and it's kind of unverifiable data, and then they just decided to plaster 35%. So I'll hit these really quick. So the ADA's Health Policy Institute reports 16.1% of U.S. dentists were affiliated with the DSO in 2024. A separate ADA-affiliated study published in Health Affairs found that the share of dentists affiliated with private equity roughly doubled from 6.6 in 2015 to 12.8% in 2021. And then the ADA workforce data show that about 2 in 3 dentists now work in a group practice of some kind. So Brian accurately points out, which is it? Are we talking about 35%, 16%, 13%, or 66%? Like, these numbers are kind of all over the place. You can kind of pick and choose what you want to take there. One other thing here is if you take the strictest definition of consolidation, which is ownership by corporate or investor-backed organization, that picture looks more close to like 16%. So the answer is the dental space is not 35% consolidated. I think that a lot of this data that was thrown out there was talking about like group practices in general, but what they basically said was if you have more than 2 or more than 3 or more locations, they kind of group that together with a DSO, which is just not the case. Right now, it's probably somewhere between 15 high and 17%. So I'm gonna leave it there for a moment. Get your guys' thoughts. I think I'll just say that these numbers are unverifiable. It's really hard to say. I think it's a stretch to say we're anywhere close to 35%. I think you got to just always check these numbers. But thoughts from you guys initially before we go any deeper on this, if at all.
Lauren?
No, I'll let you go first.
Okay. It's not because of DSOs or how many locations each dentist has. It's I would zoom out and really just look at it at the industry level from like basic economics, because that determines whether an industry can be concentrated and consolidated or not. Some industries, they can only be profitable and succeed if they are monopolies and oligopolies. Think of your electric power plant in your city, right? You don't have 25 electric power plants in one city.
Good
or
point.
Else no one would make money, right? You need it to be concentrated in one. And dentistry, I do not know of any place where there is one big mall in the whole country where everyone goes there to attend to their teeth to, right? Dentists are scattered everywhere. And what makes dentists profitable usually is their location. It's like, are you in a place where you're winning a market around you, in the neighborhood, in the city you're in? That is what happens. Given that the product or the service from an economic point of view is location dependent and works on territories and proximity, makes it very hard for a large player to come in and win all these territories. Buying stuff, yes, we had grocery stores, but it was feasible for something like Amazon nationwide to control and create a web. But until we see one big DSO or a dental corporation that has as many branches as there are independent dental practices out there, I don't think the dental industry from an infrastructure point of view can be consolidated like we think the same idea, similar to when we think about concentrated industries, such as like what Amazon does or what utility companies do, etc.
Yeah. It's a great point, Rabih. I'm glad you brought that, like adjacent industries and just how the economy works in these spaces. It's a really, really good point. Lauren, any thoughts that you have on this?
I feel like that's a perfect point. That makes a lot of sense. Yeah, it'd be tough if there was just like one dentist in the a big mall of dentists. That'd be wild.
Yeah, I mean, we've said this before, and Brian plants his flag in the ground here, and I totally agree with him. His take is that we're not getting above 20% consolidation in the dental space. We've seen it slow rapidly.
Mm-hmm.
And it was tough a few years ago as we were feeling pressure. It was like the Bitcoin level pressure of like, I remember posts online about like, you are an irresponsible advisor if you're not talking about Bitcoin. I felt a very similar pressure with DSOs and being like, oh my gosh, should we be like jumping in on this thing? Mm-hmm. That wave came, it went, we now see, according to what data you're looking at, somewhere as high as 40%, but somewhere between 25 and 40% of DSOs and corporate-backed groups are in receivership. They're like not only are they not thriving, they're literally going under. And then you look at the number of deals happening right now, it has fallen off of a cliff. And so, Rabih, I think you're highlighting the macroeconomic environment and maybe the microeconomic environment, more micro of the dental space and why it's so difficult to do it. I also think dentists are just pushing back. We hit that wave. We saw the crap flow through the market. People heard the stories. We've seen it sadly with some of our clients and other dentists we've talked to, like the really, really bad stories. And I just think it's come to a screeching halt. Does that mean consolidation's going away completely? Absolutely not. It's going to continue at a pace of some kind. It's just, I think it's rapidly slowed. And I agree with Brian. I think we're seeing a max of 20, maybe 25%. It's, at the high end is would be my guess. One other thing I want to highlight here, guys, which I think is so important. He mentions a number and he says, this is never going to make the scary headlines. But according to ADA's own ownership data, nearly 3 in 4 U.S. dentists own their practice today. So there's still 75% ownership of dental practices in the private market space. Ownership is still happening. Dentists still want to own their we see this. I'd say it's about 70 to 80% of dentists we talk to still want to either own or want to own a dental practice. The Health Policy Institute did talk about how it's gotten older, kind of like home purchases. Buying a practice, you're doing it a little bit later out of school, which I think that makes sense. We're seeing dentists use DSOs kind of like as a launch pad into private practice ownership. But if you're out there as a young associate or a young dentist or coming out of school and you're listening and you're thinking, man, this ownership window is closed, there's just no way. That is not true. It is just unequivocally, it is unequivocally not true that ownership is not a viable path forward. To us, it is still the path to take when it comes to living a fulfilling life and building a fulfilling career in dentistry. It is absolutely still viable. Any other thoughts that you guys have on any of this private practice ownership, consolidation, DSOs, anything like that?
I feel economy?
Like in this economy?
Maybe I don't understand, or maybe I need some education on this, but I feel like if I look at like a doctor like practice or private practice versus a dentist, I feel like doctors always do groups. So I'm like, even if there was like more groups, is it really that bad? Is it like a cultural thing, or is it like dentistry just really is that different? Because I'm like, anytime I go to a doctor, it is a group practice.
Yeah.
Whether they own it multiple people or it's like they're under some sort of group. I'm like, I don't think I ever have like a small office with just one single doctor. Versus dentistry, that's like really, really common. So I guess I'm like...
Yeah, it's a good comparison.
Is that like a cultural thing, or is that like just because of dentistry, like because it is different? Like
I think it's a structural thing. If you look at the MD space, which has been consolidated for a long time, I think over 50% for a long time. I think it's structural. The MD space is hospitals, hospital networks. I'm really glad you brought this up, Lauren, because I think people think just on the surface, well, like, look what happened to the MD, like, look what happened to the MD space.
So they think like because it happened to them, they'll think it will happen.
But it is apples to oranges, because as Rabih pointed out, the structure of a dental practice is literally just a small business. It's just small businesses scattered across the country. It's not massive hospital networks that is far easier to consolidate. It's not even close. So I'm really glad you brought that up. But let's get Rabih in here on final word on that question or that thought.
No, I agree. And here's going to show my ignorance of the dental space in general. But when you have a group of MDs and you go to a family doctor, and then that family doctor refers you to go get some ultrasounds and maybe do some blood work, and then, I don't know, go into surgery for something. Look at all the different equipment and all the different sections or rooms in a hospital room that are very specialized and costly to build up, that are required for you to just go from a family doctor to healing what you had anywhere across your body. Whereas in the dental space, well, I could go to a dentist who's also an oral surgeon at the same time, and everything is happening with the same machine. Yes, you'll add probably one chair or two that are more specialized, but you're not adding a new section of a building. And for that reason, one person or two, in the case of a dental practice, might be able to afford it and make the economics work. Whereas in an MD, where you need an X-ray room and an ultrasound room and a surgery room and ICU unit, etc., it might require more than one pocket just to make the initial investment to build that.
Yeah,
that's very interesting.
It's a really good point, Rabih. And just to that point, let's hope it doesn't happen, because you see what's happening in the healthcare space, the general healthcare space, and we're seeing it a little bit in the dental space of like the DSO owning all levels of the supply chain, right? You see this all the time in healthcare, like the big major insurance companies basically own point A to point Z of the supply chain in healthcare. Every single thing you just mentioned, Rabih, is owned by like the big insurance companies. And it's a huge problem. And then you see what happened with DSOs, the DSO in Wisconsin, who bought all those practices, and that kind of like stirred up a big controversy. Again, you hope this stays slow. You hope the pushback continues, because we are firm believers in private practice ownership and that being maintained here in the US. Let's hope it stays. So any final words, guys, Lauren or Rabih? Okay, awesome show. I feel like we covered a lot of great stuff, as we always do in this economy, Rabih. Okay, if you're out there listening and you are thinking you need help with this, you are interested in talking private practice ownership, or you're a private practice owner and you need help, anything to do with growing your practice, tax and accounting, insurance, investing, we are here to help. Dentistadvisors.com. Click on the book free consultation button. We talk to hundreds of dentists all over the country. If you're lucky, you're going to get Lauren, if you're lucky. And we'd love to talk to you and help answer your questions. So dentistadvisors.com. For now, Lauren and Rabih, thanks for being here and sharing your words of wisdom. Everyone, thanks for listening. That was our 2 cents. Until next time, have a good weekend. Take care. Bye-bye.